Hi, good morning. Welcome to the weekly market brief from Morton Brown Family Wealth. I'm Dennis Morton here with Cody Demmel. Cody, how are you?
Good, how are you?
Good. Thanks for joining us for a cup of coffee this morning. We've been doing these briefs here for the last few weeks just to keep you updated and informed about how we perceive what's happening in the marketplace. It's been a busy week this week so far, Cody. A lot of things happening. We've had an inflation print that came in pretty hot last week. A lot of market volatility. Anything that we gained here in the last few weeks and kind of a relief bounce, we've given back in the last few days. We're going to spend some time talking this morning about bear markets, but we also want to field any questions that you might have. So feel free to jump in the chat if you have any specific questions about what's happening in the markets. But Cody, let's start with where we stand right now. Really, what led our way up last year has led the way down this year. Let's start there and talk about kind of what's driven things down.
Yep. So as we know, we've had solid gains over the last couple of years, and we had that strong decline in 2020, but then the strong bounce back, and a lot of it was led from some of the high-flying technology stocks and growth stocks. Those have been hit the hardest so far this year, and we've seen the decline in the NASDAQ, which is one of the higher growth sectors, of around 30% so far this year from the highs. And it's bringing down some of the overall economy or the overall stock market, with the S&P on Monday closing officially in a bear market, which means its decline is 20% from its highs.
Right. And some of those names, you talk about something like during the pandemic, a name like NVIDIA was up 466%. It's down 48% now. Microsoft was up 146%. It's down 28%. And the important thing is to realize that just how disproportionate those increases and decreases are. There were some massive upswings that happened. And if you own an index fund, whether you own an S&P 500 fund or the QQQ, which is the NASDAQ 100, you have a good portion of some of those large companies in there. They might make up 2, 3, 5%, depending on the name. And they're going to, push and pull on your index as you own it. The index doesn't care. It's going to own those things regardless. So you kind of capture a lot of that up and down swing. So Cody, you want to pull up that chart that talks about, we found the chart in the Wall Street Journal that talked about some of the performance of sectors and just how, we talked like weeks ago about the V shapes and the inverse V shapes. Let's talk through this chart a little bit, what it tells us.
Yeah, so this is a interesting chart that goes back to the pre-pandemic high of 2020. So before we had the sharp decline, you can see the black line is the S&P 500 as a whole. We were down around a little over 30%. Then we obviously had that sharp bounce back to the record close, which was beginning or at the very beginning of this year. That's the S&P 500. Then we hit the bear market and we're down around 20% from the record close, still positive from the 2020 pre-pandemic high. But then if you look at certain sectors, so it breaks it out with technology, had a very strong run up from the lows of 2020. But then if we look at energy, obviously not all travel, but a lot of travel, especially business travel and vacation travel, was shut down in 2020. So the energy sector got hit hard. But then we see with the gas prices so far this year and the supply chain issues, energy has shot up and is actually the best performer from the pre-pandemic high. So not even from the bottom, but from where we started 2020, energy is the best performer. And as you were saying, Dennis, you can just see this very fast and rapid changes that happen sometimes in the stock market.
And for you and I who've been observing the markets for a long time. The crazy thing is, where's the last place you wanted to be before 2020?
Yeah.
Energy. It's just, energy, I can't remember the exact number, but energy used to be a pretty sizable portion of the S&P 500. If you look back to the mid 2000s, I mean, when we hit $100 a barrel energy in the late 2000s, $100 a barrel oil, energy made a substantial portion of the economy, and it just collapsed over the last 10 years. And, for a lot of reasons, and it was the last place you want to be, which brings up the question, especially as things are down, is if I told you that the best place to be right now over the last couple of years was the worst place to be a couple of years ago, how does that make you think about the present?
Yeah, exactly.
We were having some conversations with people who were scared. We know that there's anecdotally, there are people who are like, I want to go to cash, or I went to cash and everything else. And you just have to ask the question of, all right, over certain periods of time, the best thing for you to do is to buy the worst thing.
Yep.
And that's a really difficult thing to do. And we're not advocating for that, to go in and buy the thing that's down the most. But sometimes that's how it works.
Yeah, especially if it's a good company that has good growth going forward, good earnings going forward. Sure, it may get hit a little bit from if the economy starts slowing down. But as long as you're not buying a company that has zero revenue and you're literally just counting on them starting to produce new products and just putting everything out. But if you're buying good, stable companies, even if we do see a greater decline this year, for the longer haul, you should be in a better spot.
That's what Warren Buffett calls a moat. Does your company have a moat around its earnings? Does it does it have a fortress where they can kind of defend things, or are they over leveraged and exposed? I'm going to do a little bit of drawing here. As everyone knows, I'm the son of an accountant and an art teacher, so we like to draw pictures here on the Morton Brown Weekly Updates. This is kind of like, I'm going to see if I can do this steadily. It's a pretty good straight line, Cody. There's our S&P trend line over the last couple of years. As you said, it's been a lot of down, then up, then down, steady trend. The challenge with all of these charts is be very careful about projecting this, taking the uptrend and saying this is going to be how things go, or worse yet, this is going to be how things go. If you take a short-term chart and start projecting directionally how it's going now, you can get to zillions really quick or zero really quick.
Yep.
But that's not how markets move. And as stomach churning as a lot of this can be when you move up and down really quickly, and here, I'm going to go offline here. If you look at a long-term chart of the S&P 500 or the Dow, the trend looks like that over time, right? I mean, but that belies all the volatility that comes through. What was the number that you put out earlier about, was it the NASDAQ or just the overall market about the last 5 years? He said,
Oh, yeah. So large cap growth, even with the 30% decline that we saw this year, its average annual return over the past 15 years is still right around 15%.
Yeah. So over that time period, so that's still that 15%. That includes the 30+% decline of 2020. That includes the 19.9% decline, in 2018. It has not been a smooth ride, and even these times can be challenging. There have even been long periods of 12 to 18 months where the market did nothing, where it was just kind of flat and bouncing around, which can also test our patience.
Yeah.
Let's talk a little bit about bear markets. So also from the journal, the same source of this, we had what happens to the S&P 500 after closing in a bear market. So again, this is courtesy of the Wall Street Journal here this week. Let's talk through this chart from the time. So we entered a bear market in the last 7 days. We have all these, 13 time periods where the markets entered a bear market. What happened in the months and years ahead?
Yep. So this chart is fascinating, as Dennis was explaining. It goes over some of the past bear markets that we've seen. And as Dennis said, obviously we had that bear market in 2020. In 2018, we didn't quite get to a bear market, but then obviously 2008, 2009, it counts as two different bear markets. But if we look at 1 month later, as we said, there can be a lot of volatility over the next month, but normally it's pretty positive after we close in the bear market. But then there are a couple circumstances, even after we've had the bounce back in the 1 month, we've seen a little bit of a greater decline. But if you look farther out at the 6 month and 1 year, there's only a couple instances where it's actually had still a decline 1 year later. And if you look at majority of the other ones, they're pretty strong returns going forward.
Right. And I think there's, this is really telling, because I think one of the interesting stats here, 6 of the last 13 bear markets have been since 2001. But I think that the catalysts were all so different. I mean, we had the dot-com burst in 2001, the extra leg down that came from post-September 11th. We had the great financial crisis. We had the pandemic. And now we have whatever this hodgepodge of catalysts that we have right now. So every one of these happened for a different reason, but the market, that's why we talk about the biology of the market. If you think of a healthy body that can fight off, infection, that can kind of, adapt and change, that's what the marketplace is. That's what the economy is. And I think one of the things that is reassuring in some respects is just how strong the economy remains in many different aspects. And that kind of gives me some optimism that we're going to be on the more positive side coming out of this, right? Yeah. So 1 year later, the average return was 24% in the S&P 500 1 year after coming out of this. So, let's be blunt about this. Is it time to go to cash? Is it ever time to go to cash?
No. Because the hardest part about going to cash is then figuring out, okay, well, when do you go back in? Is it when we're up 20% from the bottom and we think it's all over? What if we have a greater decline there and you miss that 20% up, even if we go 10% lower? That's one of the hardest things, is just figuring out, when do we go back in? When is it all safe again, to put your money back to work? And I think that's why, if you look over the long haul, the average investor, there's all those studies from Vanguard and BlackRock that the average investor's return is so much lower than just the S&P 500, because they try to time it a little too much, but the emotions get in the way sometimes.
Yeah. So I mean, if the question is, should I go to cash? It's tempting to make it a binary decision, like all in, all out, right? Yeah. And that's that's kind of a stressful place to be. I think an important acknowledgement is that when times like this happen, we always feel like we should have had a little bit more or a little bit less. Like last year, someone could say, I wish I had a little bit more exposure to cryptocurrency or tech stocks or whatever was, going up by, multiples, geometric growth. At a time like this, we say, man, I wish I'd had more cash. Well, that's probably it. There's nothing else you would have gone to that would have been preservation minded, right? I wish I'd had more cash, but that's tempting. But what if your exposure was just right for last year? What if you captured enough of the growth? And what if it's pretty good for this year? If you're sitting with some balance of stocks and bonds, you captured some upside last year because your stocks grew, and you're doing some semblance of protection. You might be down 8 or 10 on a diversified bond portfolio, but you're not down 30 like the NASDAQ is. You're not down 20 like the S&P 500 is. And you might have some things that are holding up pretty well. So it's a matter of degrees.
Yeah.
So we're put pop questions in the chat. We're going to talk a little bit now about what was something else that we saw. So there was we had the facts about bear markets. Cody, what do we know about bear markets? Because there's a fuzzy definition. It used to be that you'd watch CNBC and they'd be like, we're down exactly 20%. We are in a bear market. And then it'd go up a little bit. Okay, we're out of a bear market. There was like this fine line. Same thing with recessions. It used to be 2 consecutive quarters of economic declines. Now I'm hearing all these fuzzy terms. Well, it's more of a feeling than it is a definition. But we found an article from Kiplinger, I believe. Yeah, Kiplinger.
Yeah.
8 facts you must know about bear markets. What are some things that we know to define a bear market?
Yeah, there were some very interesting facts that they put out there. I mean, one of the, just off the front, as we said in the beginning, a bear market officially is when we're down 20% from the highs, which is the S&P closed in a bear market on Monday. But then some of the interesting stats, so there's been 25 bear markets since 1928. So almost over the past 100 years, there's been 25 bear markets. Only 14 of them happened during a recession or occurred when the recession was coming up. The other 11 had nothing to do with the recession, and it was potentially just the stock market pricing in a potential slowdown or a recession potentially happening. And those 11 that happened without a recession, the decline and the bounce back was much, much faster.
Yeah. And that's what we talk about, the terrorist attacks of 2001, North Korean missile crisis of 2017. Recovery time is full recovery of 45 days on average. And that's I heard it again this morning listening to, I think it was listening to Bloomberg, and just some of the interviews. If you listen to people talk about some of their concerns about the markets, they say things like, "This is going to be a tough quarter," or "This is going to be a tough time between now and year end." So that was something that we pulled up a piece from Alhambra Investments, Joe Calhoun over at Alhambra, and he talks about if you have a longer term view, like some of these things can be opportunistic, right? There's a lot to be said for shifting your focus out longer. And one of the things that we have as an advantage as retail investors, as people who are just kind of managing our personal portfolios, we don't have to do anything. Sometimes if you're an institutional investor, or you have to report out to people all the time saying, this is how we did relative to our benchmark, the expectation is that you're going to do something. You're going to step in and jump on it. And sometimes the right thing to do is just sit pat.
Yeah. There are some beneficial things we can do, and say if we have just a taxable brokerage account, we can do some tax loss harvesting, go into a similar fund, not miss any time in the market. But this isn't a time where we have to try to time it or get more conservative or get more aggressive, assuming that either we're going to have a bounce back or a softer sell off. But don't try to make timing there, but try to do some things that could be potentially beneficial for you over the long haul.
Yeah, and you're right. Taking that view that this is a bear market is not necessarily a bad thing. It does present some opportunities. But also, I think recessions have become four-letter words. We went a long time without one. Heading into 2020, it had been a really long time, one of the longest times on record without a recession. And if we go back historically, it used to be that we would have depressions on a pretty regular basis. If you look through the 19th century, it was, depressions and long stretches where we would have, circumstances where the economy would just tank and have to recover. That was pre-Federal Reserve. We didn't get the Federal Reserve until the 20th century. And the Federal Reserve's job was to make sure that they regulated the flow of money to help, mitigate the impact of depressions. So some of that the Fed learned a lot in the Great Depression when they didn't mitigate that exactly. But over time, we've gone from having depression to recessions, which were pullbacks. We didn't have massive craters, we just had pullbacks. Eventually, over time, we've just become scared of even the recessions, even the pullbacks, and the R word has become a four-letter word. But it's not terribly bad. I mean, in the Alhambra piece, it talks about falling back to a slower trend from an artificially high one is not necessarily a bad thing. I mean, if we've been, to your point, if certain aspects of the market have been racing ahead by double digits for the last so many years and are pulling back to a more reasonable level of growth, that's not necessarily a bad thing. And in fact, that's probably what needs to happen to stem inflation, right?
Yeah, that's exactly what the Federal Reserve is going to try to do: slow down the economy at a good pace so the inflation numbers slow down. Because that's as they say over and over and over, that's the most thing they're concerned about too. Jobs are still very strong. We see all the companies still trying to hire jobs, especially the smaller businesses. But they're trying to slow down the inflation number just to hopefully steady things out a little better.
Yeah, and household balance sheets in pretty good shape still. I mean, people still sitting on a lot of cash. I think a lot of it is these things are moving so fast. Kind of coming back to that first chart you showed, there's spending, there's inventories, sorry, if cars flying by. This is real time, people. So we can't help those motorcycles driving by. But you have these massive disconnects between we demand this, we have inventories here, and over time we just start to tamp it all down so it can catch up a little bit. I think that's what the Fed's trying to do. Anything else about bear markets, Cody, that you think we can observe? You talk about it doesn't necessarily equate to recessions.
I did think the one stat they had about the average length of a bear market since 1928 was only 9 months, where the average length of a bull market is a little right around 3 years. We've obviously had a much, if you go back to 2009, you can say we've pretty much been in a bull market since then, even though we've had a couple stronger declines, but we bounced back very fast. But I did think that was interesting that the average length of a bear market was only around 9 months. Obviously, there's some that are a little longer and some that are a lot shorter, as we saw in 2020. But I thought that was a fascinating stat.
Yeah, yeah. And as far as the places to go, like where to go during a bull market or a bear market, it's interesting because it feels so recent that there was a clamoring to get into all the things that worked last year. Like we were talking to people about how do I get into cryptocurrency? How do I get into the things that were working so well last year? They call it the momentum trade was really it. If you bought more of what was working, it kept working better. I think we need to be careful a little bit about what works well in a bear market because, like you talked about, some of these trends tend to be very short-lived. Like the duration from the time we hit bear market or the time we hit bottom tends to be pretty short. So if you say, I want to know what works in the bear market, you're really saying what works in this really short window here. And, when we have yields going up a little bit, we have yields going up, fixed income drops in prices. So it doesn't feel like there's a lot of safe places to hide. Eventually, we would expect some demand to pick up for things like treasuries, high quality bonds, right?
We did see there were some articles that came out over the past couple of weeks that Uni Bonds are starting to see a really strong inflow. So people are diving back into that, where at the beginning of this year, they were kind of exiting Uni Bonds, but you've seen a very, very strong pickup again into municipal bonds, which is a good thing.
Yeah. And I think that's the thing we have to talk about is, I was talking with a client the other day. If we get lower prices on stocks, but higher yields on the other side, it's not all a bad story. There's some balance out between a lower portfolio and higher yield. And if somebody says, listen, I can get 1% more tax-free on a muni than I could a year ago, there's some appetite for that. So I'm not surprised to see that flow.
Yeah.
So we're coming up on the end of our time here. Cody, any other observations, just things that you're hearing from clients or questions that have come up in the course of conversation the last week or so?
I think everybody's obviously concerned with the inflation numbers we've seen recently, and then obviously the decline we've seen in the market. And the tough thing about this year, as we keep saying, is it's not just stocks; it's fixed income too. So we're in a unique situation. But again, I think there are some beneficial things you can do, whether it's tax loss harvesting in a brokerage account, or just making sure you have the right risk tolerance. And now is probably not a good time to make a drastic change there. But if you go back and you look at some of the articles that say people were willing to take a much more risk when the market goes up and up, which makes sense. But now when we're off 20, 30%, where you can make the argument now would be the better time to get a little more aggressive, people want to do the opposite, which makes sense. But if you went into a store, you don't want to buy something at retail. You want to look for a sale and try to get the item at a sale price. So.
Yeah, this is the only place where people panic when things are cheaper than they were before.
Yeah, especially if it's a good company, as we were saying earlier. Like there may still be volatility, and there will be volatility over the next couple months or year. But yeah. So one last thought. I wrote a couple of years ago a blog called "How to Be a No Conscience Investor," and we're in the NBA Finals right now, so it's an interesting time to talk about it. The idea of being no conscience. My father, I remember sitting with him at a basketball game when, we were watching a shooter, and he was having a really tough start to the game. And he was point guard, and he was firing up 3-pointers, missing a lot. And then all of a sudden, the switch flipped, and everything started going in. I remember my father turned to me and saying, "That guy has no conscience," meaning that he knew his job was to shoot and to keep shooting because eventually the ball is going to go in. That's his job. His job is to not stop shooting when it's not going in because he's not helping his team. And I think there's a lot of that goes into investing, is that our job is to kind of seek out returns because we need to grow and keep up with our pace of inflation. We need to keep up with cost of living. We need to grow our nest egg for a lot of our financial goals. We don't have the option of just stopping. And the opportunities will present themselves if we're patient, if we keep doing the good things. So you think of a Steph Curry's for the Golden State Warriors. If he's having a bad first quarter, he can't just say, "Coach, take me out. I'm just not having a good day," and sit out. They need him to kind of keep doing what he does well. That's why it's important to have an investment philosophy
and the things that you know work well in the long term, because eventually it comes around. So being no conscience is an important characteristic of an investor. If we let that sneaking suspicion, and the conscience is that chirping in the back of our mind saying, hey, don't you know things are going to be bad? Don't you? It's not working right now. You got to silence that voice a little bit and say, what are the good disciplines we can have? What do we need to keep doing to stack the deck in our favor? And being a no conscience investor, that's part of it. So, yeah, great. Well, thanks for joining us this morning. We appreciate you hopping in. And these are all conversations that we're going to continue to have as the market develops. But if you have any further questions, feel free to reach out to us directly. We'll be happy to address it in another market update. Until next week, we'll talk to you soon.